Hello and welcome to the second edition of the Outlook Money Insurance Summit. The topic of discussion today is COVID's impact on the future of life insurance. And we have with us eminent industry leaders, Ashish Vohra, Executive Director and CEO of Reliance, Nippon Life Insurance, Kamlesh Rao, MD and CEO, Aditya, Birla, SunLife Insurance, and Mahesh Balasubramanian, MD and CEO, Kotak, Mahindra Life Insurance. A very happy new year to all of you, and thank you so much for joining me today for this discussion. So, diving straight into today's topic, the COVID pandemic affected almost everyone in more ways than one, and not just individuals, but industries and sectors as well. And that includes the insurance sector, of course. So, when it comes to the insurance industry, what is that one major change that was seen because of the pandemic that all of you witnessed? And maybe Kamlesh, you can go first on this.
Thank you, Sridhi. And my first reaction to that would be, for us, I think 2 or 3 things changed in a big way. I think we witnessed BCP of its kind for the first time, where the whole country would be out of action and out of work, and therefore I think tested our digital capabilities and technology to the hilt. That was one big thing that we were learning. And I think on the customer side, over the last 1 or 2 years, the 2 big things that we are seeing is risk awareness and risk averseness. Both for customers has gone up significantly. And I think in some ways that has really helped the life insurance industry. And the 2 things that normally get impacted when these go up is 2 questions get asked, which is important from insurance point of view, is, am I insured? And for all those people who are insured are asking themselves the question, am I insured enough? So I think these have been broad changes for us as an impact of the code.
Ashish, what would you say to that? What was that one major change that really the insurance sector saw because of COVID?
I think to me, in addition to what Kamlesh is saying, one big thing that happened was that organizations needed to stand up and demonstrate agility. Agility is something we used to, read about in textbooks, preach about it, talk about it. Now, here was a time where we had to stand up and really demonstrate that organizational agility is possible. Now, agility meant working remote. Agility meant pushing your digital capabilities to the hilt. Agility meant different ways of articulating to the customer. Agility meant even prioritizing to say which kind of customers will I reach out more to at this time. For example, agility for us meant existing customers cross-sell is going to be easier in times when face-to-face meetings is going to be difficult. Agility meant managing triple the number of claims without impacting customer service and customer delivery, because this is the time he needs delivery the most. I don't think any insurance company was geared up to manage 3x, 4x the number of claims. And therefore that needed us to move people, move manpower, operate remotely, operate 24/7 in shifts to be able to deliver value to customer at the time when he needs it most. So my one word answer, what did the insurance industry witness? Agility, demand for agility and delivery of agility.
Right. And what would you say, Mahesh, to that? If we were to ask that, what was one major takeaway that you saw in the insurance sector during COVID?
I think risk. I think I actually used to work in the general insurance industry where claims and risk were really something was a day-to-day topic which was discussed. But I think here, the whole idea of mortality and claims itself is something I don't think the industry had ever witnessed this kind of scenario. So I think COVID moved from unknown to some extent a known unknown now. And hopefully by the end of this pandemic, it will become a known. Hope it will become an endemic. So I think the entire area of risk management, understanding risk, ability to assess risk, and the fact that if something can happen, has a probability of happening, it might happen. So it's no longer in the realm of probability. It can happen, and organizations need to be ready to assess the impact and move forward and operate when the event actually comes into the fore. So I think that's the biggest learning. And I think across the industry, I must say, not only at Kotak Life, but I'm sure the industry has really measured up to this ability to manage in these kind of environments. A lot of things have changed from the day we entered the pandemic till where we are today, right in the middle of a wave 3. I think the entire understanding of risk, pricing, risk, I think insurers would have become a lot more wiser. I think I've graded more. I'm sure all my other colleagues have either lost hair or grade more on risk management.
So all of you have mentioned that of course the claims went up during the pandemic period, and there were way more claims to settle than usual. So how did it affect the balance sheet of companies? As in, how did you take? Was it a loss, or how was the revenue kind of balanced in view of the claims?
I think let me go there first, because I think we were the first out in the market as well. Way back in June, Kotak Life sent a letter to our shareholders and through SEBI saying that, look here, we are looking at extra provisioning related to mortality, and therefore we had to tell the market about the upcoming numbers that we are going to report for the particular quarter. I think the biggest challenge was assessment of the claims itself. What is coming in, what has come in already, what is likely to come in. And our businesses are of varied types. We have a group term insurance, which is the employer-employee. Then there is a credit term, there is an individual term, and then there is an individual protection kind of a business. So I think the most important thing was to assess the impact of the excess mortality on each of these lines of business, because each of these lines of business actually will behave very differently to the same pandemic. Let me give you an example of why it will behave differently. See, wave 1 was all about senior citizens. Wave 1 was all about a different demographic kind of population. Wave 2 was about urban India. Wave 2 was about employees who are 30, 35, 40-year-olds working middle-aged, working in the corporate sector. Right? Not that it didn't affect the rest of the country, but it was about urban India. You had Bangalore, you had Chennai, you had Hyderabad, you had Delhi, you had Calcutta, Mumbai. These were the cities which were really seeing a swarm of mortality getting reported. So I think one need to assess the impact of what it's going to be on different segments. Now, if you're an employer-employee business, this is the first business which gets affected because urban India employees were dying. These are the same people who take loans from various companies, right? Any bank or any lender would probably lend to a salaried class, an employee of any of the top IT companies or FMCG companies or other companies, software companies out there, because they are the best credit, right? So therefore, if you have been in the group term, it's going to affect the credit term as well. Then we have a microfinance segment, which is slightly different. It is credit term, but a different segment. In microfinance, the impact we realized was going to be lower because the mortality was anyway elevated even during pre-COVID times, right? So it's a question of the delta mortality getting built up in those 3 months. How is it going to sit on top of the existing mortality that you had anyway budgeted for or anyway planned for in your business? So doing this entire assessment was a very complex exercise. And I must say at Kotak Life, we were very happy that we got onto the curve very early, and we were able to predict with a reasonable amount of accuracy. And I think we made some provisions in the first quarter, and that stood us in good stead for the entire year. So I think the assessing this impact in terms of various lines of business and what is going to be the extra mortality that we need to provide for was in itself a very big challenge. At least that's what we realized at Kotak Life.
But also, in a way, it was unpredictable, as in the number of deaths. I mean, there was initially, the second wave was not taken so seriously. And then suddenly, the numbers went up like anything. So how did you, come to terms with the whole business proposition in that sense? Kamlesh or Ashish, if you want to come in on that.
Nidhi, I think, let me answer that in 2 parts. One is, how do you do the mathematical modeling? Mahesh talked about some of that. In Reliance Nippon Life, we borrowed some of this know-how from Nippon Life because really the domestic market had not seen a pandemic. All we had seen is some earthquakes, floods, and things like those. And therefore, there is a very different way you model the localized mortality in events like those. But when it comes to a nationwide pandemic, moving at a particular pace, the way you model it is very different. And like we were talking before the call started, we created very sensitive dashboards that talked about which line of business in how many days or in how many weeks is going to produce what kind of mortality and what impact. And therefore, you try and steer against it. It is an inevitable that's going to hit you. and you steer against it by trying to leverage other revenue lines. Can you move product mix in a particular manner to bring about releases on the bottom line? Can you manage expenses in a particular manner? Can you postpone some elements out there? Thankfully, the investment side did well, and therefore those created some buffers and some countermeasures for us. So that part is about how do you model and how do you come to terms and how do you deal with it and how do you build countermeasures to still manage the bottom line without dramatically upsetting everything. Having said that, quarter one was a very large loss for us, like Mahesh was saying. For the whole industry, everybody went 3x or 4x on claims, and therefore that had to be negative on the bottom line.
Right.
Let me sort of add a slightly different flavor to this, Nidhi. At least in our company, we did not spend a lot of time fretting about it. It is inevitable. How do you manage it is the best way to think about it, but you don't fret about it. In real terms, the life insurance industry is built for times like these, isn't it? End of the day, we sold a promise to the customers to say, if something happens, Khuda na khasta, kuch hoga to hum hai na. If that is the promise we sold, when the time comes to deliver to that promise, we don't sit and fret about it. So we're quite okay with that. And I think that is the dharma of the whole industry, that we will deliver on the claim side. And I'm so glad to say that, we are at like 99% on claim settlement ratio as we speak. And so is the whole industry. Everybody is above 98%. So in times like these, when claims were 3x, the whole industry went up in terms of claim settlement ratio. And therefore, that I think is the other perspective on the whole game, to say, how do you model? But at the same time, we were built for times like these. We carry adequate reserves for times like these. And we are happy to take the loss. We are happy to take that 1 quarter, 2 quarter of damage. Because end of the day, we are building a deep industry and it is building faith in the sector to say, right, this is a financial product we want to be investing X% of our savings in.
So that brings me to another question. Like we were discussing, like a lot of middle-aged people lost their lives, a lot of families lost their breadwinners, and this whole pandemic also had this impact of people becoming more aware of the importance of life insurance, health insurance, also life insurance, because of so many because the mortality rate was so high. So did that also mean that it translated into more business for you over the period that, after the second wave was over? Did you see an increase in demand? Because at one level, maybe you did take losses, but perhaps, the number of buyers or number of policy holders who were interested in these products, who were not aware so much earlier, now increased. So how was the experience on that front?
COVID definitely hit a lot of life insurance companies. But like Ashish mentioned, I mean, we are in the business of creating reserves for such turbulent times. But it also created an opportunity. Life insurance is seen as more a push product. I don't know whether I can call it pull, but I think the nudges that we needed for people to think about life insurance has gone up significantly. And that will tell you whether the protection demand has gone up by an X percentage for different, but industry in general, it has gone up by about 30-40%. There's also the time where interest rates started coming down. Of course, before going up right now, there was a period when they started coming down. And therefore, people started looking at life insurance products, which we offer on savings platform, as significantly as what we offer on the protection platform. So it was not just about term plans, but there are a lot of products that we offer on savings on guarantee basis for 20 years, 30 years, and 40 years, and that saw a reasonably large uptake. We saw uptakes on, it typically meant that if you reach out to 10 customers and one would tell you that he's interested, we saw that number go at least by 2 times. It means we saw some doubling in terms of our prospecting to conversion ratios. If you look at the productivity, by and large, for the industry and for some companies, it actually helped that going up. And therefore, if you look at over the last 1.5, 2 years, this is one industry that is growing in a very stable and steady fashion. Last year, in the first year of COVID, it grew by about 8 to 10%, currently growing at about 20%. And within that, the private growing at about 30%. And a large part of that has come on better efficiencies. It basically means that we've got an upside on the top line, but we've been able to manage our costs better. So the economies are looking better. So yes, you would have had an impact like Ashish and Mahesh mentioned about claims, but that is something that we should provide for and build in. And that's the essence of a 30, 40-year investment company like a life insurance company. But it has had its benefits in terms of uptake in business over the last 2 years. And we see that as the third wave is hitting. We look at, there's an interesting data on as and when you see the new waves coming in, whether on the online platform, are there the search for insurance or protection or something goes up, it goes up exponentially. And the other worry that I always have, having been in the financial services industry for 27 years, is the memory of Indians short? And is there a time that this will go up and again go away? But for what I have seen in the last 2 years' time, and for what, like Mahesh said, so many unknowns that we now believe can happen. When we started, we thought this will go away in 3 weeks or 3 months or 6 months. It is here to stay for 2 years' time. I think what has happened is going to make sure that the life insurance industry will actually do significantly well on a sustainable basis for maybe the next 3 to 5 years kind of time.
Let's all hope for that, because insurance is a product that people need, but a lot of people do not understand this whole this idea of not imagining your death and looking at it as a morbid product and all of that, especially when it comes to life insurance. But you were talking about that whole search thing, and how you can see the searches going on now that we are pretty much in the middle of wave 3. How much has digitalization made a difference in terms of, even when it came to settling claims during the peak of second wave? And I'm assuming, a lot of the flow of claims would be much higher on a daily basis. So did that help in any way? And how did that kind of made systems more efficient? Ashish, if you would like to take that.
Like one of the speakers was mentioning, it tested digital capabilities very significantly. And again, let me talk about claims as one part, and then business as another part on digitalization. On the claim side, the whole digitalization is mostly around managing the communication between branches and the head office. Bulk of us have central processing of claims. Now, bulk of the processing beyond of that, the document inspection, etc., is mostly physically done. So digitalization really helps in managing the communication. Like you log in into a branch, and the consumer behavior on the life insurance side continues to remain that they submit a claim in the branch, while facilities are available that you do it centrally. But the take-up rate of some of that is not there. Somehow consumer confidence कि मैं ब्रांच में गया, मैंने क्लेम सबमिट किया, मुझे टप्पा मिला, appears to be of a higher order. So that part is not so digital. It continues to be physical. But the transmission, the receiving is instantaneous. And beyond of that, it is sort of manual again. What is digital is the credit to the customer's account. That happens instantaneously. Almost 99% of it is now through NEFT, etc. The other impact of digitalization, and besides searches, etc., is really how insurance companies have managed hitherto manual processes by converting them to digital. So how do you recruit digitally? How do you assess an employee digitally? How do you, without getting into very far-fetched OPQ kind of models, etc., how are you able to do scale assessments in a digital kind of a manner? How are you able to offer customized proposals to customers specific to their age, etc., specific to their liking in a digital manner to aid in conversion rates of 1:10 becoming, say, 2:10 and things like those. So my personal view, the digitalization in claims is of a lesser order. Unlike the general insurance industry, and Mahesh will tell us about the big difference between the GI claim settlement side and the LI claim settlement side. But on the other side, on making several of the manual processes become digitally oriented so that they are more repeatable, so that they are more predictable, I think is the larger impact of digitalization, more so in the COVID time. All of us had toolings like these. The utilization of those was 30%, 40%. As lockdowns came in, as difficulty of customer appointments came in, the utilization of those digital assets went up to 60%, 70%, and things like those.
Okay. Okay. So, so what I'm getting is also that, it was more on the process side and not really the customers, especially on the claim side, maybe not on buying and all that. Maybe, the KYC and all were being done digitally. But when it came to claims, it was not really that it came into play digitalization, because we have been hearing a lot about it. So I was just wondering that, how come it was just processes and not really, because a lot of other, another panel that I was talking to, they, some of them also mentioned that, even the claims processing in terms of people's money getting debited into their accounts and all of that got, got a push because of digitalization. But you
I said that.
really
I said
would
that.
say
The crediting of the money, definitely 99% is digital. But I was mentioning more around how do
The
customers
filing.
submit life insurance claims, those kind of things. I must also tell you that, depending upon what business models are there amongst us also, there might be some differences out here. Now, we operate a significant amount of tier 3, tier 4. Now, there is a particular consumer psyche that operates in the tier 3, tier 4 that still believes in the physical walk to the branch.
Right.
That is not quite the metro behavior, maybe. So each of us has somewhat different. So we don't sell as much through banks. So the behavior over there tends to become somewhat different. So when you're not selling so much through banks and you are a tier 3, tier 4, there is a higher dependence on physical, because that's your consumer set, and therefore you tailor make your claims acceptance processes depending upon what they would like. They are more comfortable coming to you.
Right.
Maybe I just want to add to what Ashish is saying is relevant. So I think you got to differentiate the ability today of somebody being able to make a claim digitally versus the actual execution of the thinking of the customers on the ground. So to the extent, like Ashish mentioned, the enablement on all life insurance companies is up the curve significantly during the COVID period. Okay, it was a different method in lockdowns. That method availability was different. Ashish rightfully mentioned, if you are in tier 3, tier 4, then obviously the consumer behavior determines the utilization. So I just want to differentiate and say that the ability for a life insurance company to do a claim digitally, I think, is up there. It's the constitution of your business. We also experience, we are there in tier 3, tier 4. We have a large banker partner, okay, say in HDFC. There everything happens digitally because the customer data is very easy, and that is available with the bank. So there is no need for any kind of a physical process in that sense. So from an ability point of view, I think it is up there, and it really accentuated in the 2-3 waves of COVID. But depending on the model of your business, depending on which markets you are present in, but the most important thing is today the money going into the customer account, like Ashish mentioned and rightfully so, to the extent of close to 98, 99, 100%, is completely on NEFT basis. So all those things of giving money on checks and all that stuff is all long past gone. And definitely the pandemic scenario accelerated this both for the life insurance companies as well as for consumer behavior changing significantly than what they used to do in the past. So I think that's the only point I was trying to make.
Just wanted to add one thing. A lot of us also have started giving the customers a lot of do-it-yourself platforms, do-it-yourself interfaces for the entire policy servicing activity, which includes claims as well as part of the. And I think the uptake on that has been explosive, because customers also realize that this is probably the safest and best way of doing it. While Ashish, I do agree that tier 3, tier 4, they prefer probably going to the branch and taking the tappa, etc. There are also lots of customers who have graduated to doing it through a mail or going it through interfaces that we have provided them. So I think the utilization has been phenomenally higher compared to what we could even imagine, and certainly compared to the past.
Yeah, that was my sense too. And in fact, that's a very pertinent point, because tier 3 and tier 4, I can completely I completely agree with Ashish what he's saying, because also the uptake, it also depends on the uptake of digitization. So definitely it can't be compared with something that is there in the metros or main urban centers. So definitely that has been a stride that the insurance industry has taken, nudged by COVID again. So,
or you think about group claims. Maybe another way to think about it is group claims. Group claims is 100% digitally submitted because there's a corporate. There's a corporate out there who's collecting all the documents and who's submitting it to you. Now, that part of the business that we have is 100% digital. It is submitted digitally, the money is credited digitally. So your premise or your other group's view on this part of digital is actually true when it comes to the whole group credit life, group term kind of businesses. So depending upon your business model, depending upon where you see it, your experience could be a little varied. But yeah, capability of life insurers to manage the whole gamut of things through an app or through digital means, etc., is up there. It's completely up there.
That's good to hear. So another thing that Kamlesh was also talking about is the kind of insurance products that people are now interested in. So my sense was that, this whole thing of the importance of protection that people suddenly realized after COVID, that perhaps the uptake of term insurance has gone up more than other kinds of products. But it's also of course, the interest rate scenario has also pushed the, traditional investment products, which may be giving a better rate than your FDs or instruments like that. So what, according to your experience, has been, which kind of products have become more popular after COVID? Mahesh, if you would like to take
Well, actually, we are in a good time. Look at the three aspects of our business. Unit-linked markets are doing very well. I think there is a play out there in unit-linked where customers are looking at equity-linked products, right? So there is a play out there. There are companies which are a little bit more towards unit-linked, and you see them growing as well. There is pure term demand. I only hope that all of us will be able to cater to the demand in terms of keeping our pricing still in an area where the customers can still buy. We are still having issues with our reinsurers, and there is a whole gamut of things happening on the pricing side there, right? But having said that, there is certainly a growth for demand is there for the protection side. On the traditional side, I think people also realizing that we protect customers in terms of some of our offerings, in terms of protecting them from falling interest rates, right? So therefore, there is also a healthy demand right out there for traditional products, because the short-term interest rates are, because of the excess liquidity in the system, the FD rates, of course, they are moving up as we speak, but the interest rates for 3-year, 5-year FDs today look far inferior compared to a traditional plan of an insurance company, which is anyway tax-free as well. So to my mind, I think it's a good time to be there. I think unit-linked is doing well for those who are focused on unit-linked. People who are focused on par or non-par, I think they are getting their growth, whoever has got the ability to grow in these times in terms of capacity and agents and products out there. And the term insurance is also growing. So I think it's a great time to be in life insurance, I would say. I can't really say one is growing at the cost of the other.
Okay,
I just wanted to make
Please.
a point with you. I think protection and term, because there is protection in every product that we do.
Yes.
So I'm saying if you look at term, we are construed as term, but term for the industry is not even, it's just close to about upper single digit or close to 10%, 11% for the industry.
But shouldn't that go up? But shouldn't that go up, Kamlesh?
Shouldn't that go up is the wish that all life insurance companies have. But at a point in time today where the claims experience has been not so great, both for life insurance companies as well as reinsurers. And remember that the pricing of term products is determined more by the reinsurer than by perhaps the life insurer. And a lot has changed. As I talk to you, we are in a big situation where the increase in the price on per term will be anywhere between give or take 25 to 30 or 35%. So, I made this comment in some other forum that maybe at a time where the demand for term could have been the highest, it's just that the price increase has just come at a very inopportune time. Now I say inopportune, but we've had the brunt of the same thing in the claims, both for insurers and life insurers. So that's a problem that we can't solve at this point in time. So it's here to stay. It should go up. It went up in between the first wave and the second wave, but the price increases have happened as I speak to you, and bulk of us have passed on the increase in the price in the first week or second week or third week of January. So we have to wait and see how will that impact consumer offtake. And remember in life insurance, if you are buying a term product today, then you got to pay the same premium for the next 25 or 30 years time. So if the pandemic goes away and the price changes after 1 year's time frame, you buy it today, you got to pay the same premium for the next 30, 40 years. Like Mahesh said, but yeah, go on.
Please. So I was actually, my next question was also on that, the pricing of term insurance, like you rightly mentioned, is perhaps going up at an inopportune time when, the demand might be going up for this kind of protective plan, which is, giving you a larger cover at perhaps a lower rate. So do you think that might be a deterrent in terms of the uptake and demand that, that has been going up, that has been seen recently?
So we don't know as yet. It's too early to comment. But remember, India has been one of the cheapest markets for term. Okay, across, if you look at anywhere in Asia, India will still be amongst the cheapest for term insurance products. The claim experience is there. I mean, you can't run away from that, both for us as well as for the reinsurers. They call for a particular change in pricing, and that is what the price is going to be for the next maybe a year or two. I'm not very sure. No, everybody asks me what is my view on the post-pandemic scenario, and my only answer is, you tell me when is the post-pandemic scenario, and then I will tell you my view on the post-pandemic. Because every time we think it is just about to get over, it looks like a new variant comes in. So not knowing that, I'm not very sure whether I can say whether the pricing is right or no. But even after this increase, if you look at the price of a term insurance product in India, it is still fairly priced. So if it is going to be like that for everybody, I think it will find a level playing field. Whether the offtake will continue, I mean, it's just too early to tell. But as I said, that is 10% at best or 8% of the business of life insurance companies. We do very interesting work in either market linked products or traditional products, and we've seen an offtake of that in the last 2 years by at least 40%. And like Mahesh said, it's a good time, and that's my belief that is here to stay and will augur well for life insurance companies over the next 2-3 years.
Okay, so that's there, but there's always this debate between whether insurance should be into investment. Of course, there are so many investment products, and they have their own good and bad parts, pros and cons. But Ashish, what would you say? Because for example, if people are locking into insurance investment plans right now because the FD rates are low, but perhaps these plans are 10-year longer, and perhaps they would have locked in an FD for 5 years. So how does that kind of work for them?
It's the same question to say what is the right time to buy property, and it's very difficult to give an answer to that as well. But let me try and attempt a response. The consumer behavior, and sort of picking on to this term debate that was happening just now. I mean, I have sort of learned to see consumer behavior as a kind of a continuum. On one end of the continuum, let's call it the left side, is all about me buying an insurance policy as an investment and as a saving for the next 10, 15, 20 years. And the term part of it is incidental. And on the right side of that continuum is a very sophisticated mutual fund buyer buying a specified amount of term, also having some ULIPs, etc. And on this continuum, there are several roads and branches to say, what are the nuances across all of these. This debate as to what is my orientation has been on for a long time. And I think the complication here is not just how the consumer thinks. The complication here is also about how the seller explains it. So we've seen the impact of training. We've seen the impact of certain channels which operate a certain product category in a certain manner. Put together is this whole complicated situation called what are the right product choices and what are the right timings and what are the right ways to buy it. In short, there is no one correct prescription on the whole thing. Let me give you a slightly different flavor on this. We do a large amount of renewal calling. We built a large amount of propensity models on persistency collections and things like those. And especially people who bought investment products end up saying that, no, I've paid for 3 years. Now I want to go into a holiday period and take my money out later. There is this debate that keeps happening all the time. Now, we've done a fairly large amount of work to say what happened to the monies of customers who invested in a ULIP 10 years ago or in a traditional product 10 years ago. And we do this calculation at the time of maturity, etc., to say, did you make a right decision or no? And you compare it with the Nifty returns over a 10-year period, and then you adjust for tax benefits and things like those. The broad answer to this is that more often than not, and I would hesitate to hazard a guess on what is that more often or not. Is it 60 or 70 or 80%? But to a very large extent, to a very large degree, people who remained invested on their decision to buy a life insurance product 10 years ago beat the market in terms of returns. And when you adjust that back for taxation, etc., they did a damn good deal at that point of time, more often than not. Now, there could always be that outlier, there could always be a portfolio, there could always be a product. But more often than not, when you do this back testing, when you do this analysis, the net result is that life insurance gave them good returns, better than market returns. Adjusted for tax, it is definitely good.
And we are talking about ULIPs here, right?
We're talking about ULIPs. We're also talking about guarantees. Now, we're definitely discussing guarantees out here. Now, you look at the current market situation, and FD is at about, say, 5% or 5.25%, and there are guarantees available between 5.5% and 6%. And then there is the taxation benefit and the life insurance benefit that comes across. And these guarantees are being sold for a 10, 15, 20, 25 years. The guarantees I sell, my company sells, is for a total of 28 years is the maximum tenure. Now, why is this not a good deal? I think it's a damn good deal to say that an FD gets me 5 or 5.25 and it's taxable. I have a taxation advantage. I can get 5.5, 5.75 and death cover and a guarantee for 28 years that come what may, you will get these returns. Most customers we meet see this as a very favorable equation at this point in time.
You should also keep in mind that, especially Kamlesh knows it, we have worked in banks. There's something called asset allocation as well. A customer does not look at each of this in isolation, right?
Yeah.
Right.
A customer who wants to invest, he feels, okay, I'm getting a guaranteed return of 6% for 10 years, 20 years. That's a damn good deal, right? So he says, okay, let me deploy some amount of my funds here, some amount of my funds in markets, some amount of my funds in fixed deposits. I think it's a question of a proper asset allocation. And today we are seeing a lot of demand for guaranteed products, even on the bancassurance platform, right? Because customers, that's exactly what RMs are doing. Talking to customers and allocating their money, saying that, look here, I think time for you to put it because you're getting a good return for 20 years, right? And that's a locked-in return, right? So I think it's not a question of either or, it's a question of doing what is right for the customer. But more important thing about insurance is that one cardinal rule is it has to be long-term, right? Anything you do for short-term, then I think that's where the insurance product really does not really give the best results to the consumers. As long as you're looking at long term, whether you call it unit link, whether you call it par, non-par, whatever, traditional, I think if customers are having a horizon of 7 years, 10 years, 20 years, I think definitely there is a merit in looking at this instrument as well.
Fair enough. So another thing that I wanted to ask you gentlemen was that what are the new innovations that are expected in the life insurance space? Because, the pandemic has made people think about not just insurance, investments differently. And we are, discussing insurance as investments also. So what are the new kind of innovations that are really on the table in terms of protection, risk management, even channeling the savings and investments of customers?
See, I think the most important innovation people are talking about is flexibility for the consumer. Letting the consumers decide what they want, how much they want, when do they want it. I think I'm seeing a lot of products launched by competition, launched by Kotak Life as well. I think the entire area of offering flexibility to customers, right? So that in terms of the amount of cover the person wants to take, the way he wants to take back the money once the maturity proceeds are available, the number of switches he's willing to make, the number of times he can decide the tenure, the amount. I think a whole range of flexibility is coming in, right? Including, for instance, return of premium has made a big impact now in term insurance because people are looking at return of premium there as well. People are talking about 5-pay products in term insurance. 5-pay and the cover is for 10 years and 20 years and 30 years, right? So I think the whole area, which I think has taken a new dimension in the last 2-3 years, is the flexibility that insurance companies are offering to consumers rather than making it a cookie cutter kind of a product. This is my product, take it, I think a whole lot of flexibility is coming. That, to my mind, is the biggest change.
A slightly different flavor or a related flavor really to the whole flexibility part is the return of what is called income plans. Now, income plans used to exist earlier. It is not really new. But over the last year or so, I'm not sure only because of the pandemic, But this thing called life insurance needs to be seen as a second income kind of a plan to give you year on year returns has suddenly become more popular. It's not really an innovation, but it is the same thing around flexibility, that it is not just about the lump sums or the endowments, but you want to get a cash flow stream for the next. So you pay for a 7-year period, and for the next 14 years or 21 years, you get an annual cash flow stream has become popular. And there are more and more products that are chasing the whole income variety. Similarly, cash bonus is something that existed, but cash bonus on par plans has become now more popular. It tends to give a consumer comfort to say there is some money available every year, and I'm not going to be waiting for 20 years to see my pot of gold at the end of it. So those two, to my mind, again, on the theme of flexibility itself, is the feel of money being closer to me and cash flows coming back sooner than later is the trend that we see. And more insurers are building products of this variety to cater to that sentiment.
Let me just complete that. I think a lot has been shared by both Mahesh and Ashish, but I think fundamental shift is towards simplicity. Can we create our products which can be a little more simpler? If you look at the buying process, I think we used to take a lot of time in terms of making the customer understand what he is buying and then the buying process. We are trying to make what he is buying simpler. Also, for every need, we were thinking of creating a product in the past. That's what life insurance used to do. But if you look at the last 2 or 3 years, there is one standard template and it has 5 variants or 10 variants to it. You want to buy a term product. Some of them want to buy and get the money only if something happens to them. Some of them are saying, if I live, give me the money back. Like Mahesh said, my return of premium comes in. Some of them are saying, if I live till 60, give me an annuity income after 60. And the beautiful part about what life insurance companies are doing over the last 3, 4, 5 years is they are building in all these options depending on when you're buying the fundamental product of term through its various variants. So you're able to take care of, say, different customers' thinking process in a singular product. The other thing that is partly happening, and I've been more a banker than a broker, and life insurance is 2.5 years old to me, is to say, can we play on different pitches? And I don't know, maybe even you being a editor in financial services, in your mind, when you differentiate term and protection, and not necessarily look at, say, life insurance as an opportunity on the savings side. Because for all the guarantee products that we spoke about, Ashish, Mahesh, me, it's like a great level playing field with fixed deposits. It may not have the flexibility of a 2-year, 3-year fixed deposit, but like Mahesh said, if you do asset allocation, there are some products that you plan for 2 years, 3 years. There are some products that you want to plan for 10 years. You want to do a 10-year investment product with a bank, it's not possible. You don't get 10-year fixed deposit.
Yeah,
so I think the range, I think, is extremely important from that point.
Yeah, I agree with that, but I just want to put in there. But what about a PPF? That'll let me be there for 15 years. It's tax free. It's a guaranteed income again. So how do I compare as a long term investment in my debt portfolio, not the equity portfolio, of course? How do I compare there?
But you have a limitation of how much. If you're doing an asset allocation and you save X amount of money, definitely some amount of money of that will go towards PPF. I'm not contesting or competing with that product, but depending upon what kind of risk profile that you have, I mean, people have this constant debate between ULIP and mutual fund. And I've spent 5 years doing wealth management business. But like Mahesh said, if you compare ULIP for 3 years versus a mutual fund, you're going to always find it costly. If you think you want to stay invested in ULIP over a 7-year or a 8-year period, it becomes as cost efficient or better than perhaps a mutual fund. And if you are invested in a longer time cycle of the market, you will, like Ashish said, beat perhaps the return 7 out of 10 times of even the Nifty. So I think the frame of reference has to be the time frame. And if you look at that and the various opportunities that today life insurance companies offer on pure term, as well as the entire range of investment products, it definitely demands a certain part of your portfolio in your asset allocation for sure.
So yeah, definitely. I've also noticed a lot of innovations are happening on the term insurance product itself. So there are riders like this coming, return of premium coming in. So do you think it in any way dilutes the very nature, the very basic concept of term insurance? Or do you think it's okay, like you said, that it might cater to different needs?
So let me just give you a simple example, and then the other panelists can take on. You look at a salaried customer. I mean, he buys a term insurance cover. God forbid something happens, he'll have large amount of loans because everybody has a housing loan, and something happens, he wants to make sure it is secure. Now you can do it through a group product, you can do it through a term product. But if you live till 60, you don't need that liability any longer. Okay. So, I mean, there are plans today where say you take a cover till about 2 crores or 1 crore till 60, drop it down to 50 lakh rupees. It allows you to pay lesser premium through your entire life cycle period. The purpose of what that term insurance is supposed to meet, it is still meeting. If I'm converting the lump sum amount to a stream of annuity after 60, it is meeting its purpose because you live till 60 and therefore you're getting a stream of income right now. You live till 60, you want your premiums back. Great, because if something happens to you during the period, you get 10, 20, 30 times of that amount. But if you live till 60, you're getting your entire premium back. I mean, it gives you a holistic range of options without deviating from the fundamental principle of what a term protection is supposed to do. So I think it's a great range to have in a single suite of products.
I think to each his own, Nidhi, because there are lots of Indians who also want to see मैंने premium भरा कुछ claim नहीं किया. I come from GI, Many customers say, अरे 3 साल से premium भरा यार, एक बार भी claim नहीं किया, Whether it is motor insurance or so, that's the psyche of some customers. If I make a premium, if he has not made a claim, he feels he's lost something, right? That's the way the Indian psyche works sometimes. So I think as long as we have the range available, to each his own. It's not that financially one product is inferior to the other. Ultimately, it's all time value of money. Where do you put? Where do you place what in terms of time duration, and therefore what's the premium or the price that you're paying for it, right? So I think the sheer flexibility that you offer makes it more inclusive, I would say. In fact, it's good for the industry because for those 5% of the people who think mujhe kuch wapas chahiye, right? We have a product for them as well. This makes it more inclusive for getting more people into the insurance ambit.
That's true, but that's also about at a certain level, it's also about awareness and knowledge and, in general, and understanding about what financial products can do for you, what insurance can do for you. Wouldn't you agree with that?
No, we have to do both, right? Keep increasing the awareness, at the same time getting them insured as well. I can't wait for everybody to change and then come to me. Right now, your current mindset, thought process is this: I have a product, you come in as well. And we'll keep changing these mindsets. I'm not saying we should not. But yeah, at least till then, we are doing a good job of including everybody, right?
So, we are coming to an end of this session now. So one thing that I would ask each of you is, what are the big learnings from the pandemic, and what do you think are the next steps from here on? Because, COVID has opened up a lot of things for us, as customers, as the industry sector, for you, the insurance sector for you. So if you could just elaborate on what are the next steps and what were the biggest learnings for you from this pandemic?
I think the memory of this is not going to be short. So I keep saying that all the goodness that we have got into our firm and the industry, we should not lose it away when the pandemic goes away. My key learnings are around the customer's buying process, the customer's engagement process, because there are 2-3 areas that we cover them in, is to say simplicity is important. Make sure more information is available, something that you stress upon, that what am I offering and what are the options that you have that you can actually pick on, but make it simple. I think that's going to be extremely important during the selling process. I'm saying the whole journey of life insurance is seen as little long. How do we make it quicker? How do we make it shorter? If a fixed deposit can be issued across the counter, why can't a life insurance policy be issued at the end of the day? I think this is something that we've got to move to, because it today takes a significantly larger period of time. Then is the learning on data. There's so much of data available, and there is so much learning, having been a banker, to say if a customer comes to you, can you be pre-prepared about what should Nidhi buy? Rather than going blank with whatever data or information is available about Nidhi, can I tell Nidhi that these are the possible 2 customers that you should buy, which is different from what Ashish will buy versus what Mahesh will buy. So you provide customization and hyper-personalization to a customer in the selling process. And most importantly, keep constantly working, because the proof of the pudding of the life insurance company is the moment of truth of claims. And there, like you asked the first question, how can I make it simpler? How can I make it quicker? How can I engage with the nominees right now to tell them that, God forbid, if something happens to the proposer, what is it that you're supposed to do? Because in India, 50% of the nominees don't even know that somebody has a life insurance. The guys who know don't even know what the document they're supposed to put in if something goes wrong. How do we engage with the customer on an ongoing basis to make sure that when the proof comes in, and they can be far better prepared? And one big change that the regulator is making, which is bringing wellness or health into the whole ecosystem of life insurance. Depending on how regulations pan out, if that moves in, my ability to engage with the customer through the entire journey of the 10, 15 years that he is with me can become significantly better and can become significantly more interesting.
Thank you. Ashish?
Right, let me sort of not repeat what Kamlesh has very eloquently said. Those are realities for the industry. One of the things we're working on going forward from here is how do we issue a life insurance policy in a over-the-counter manner. And I'm, staring at my phone. We've launched today a straight-through processing concept where we promise to the customer that if you agree to do everything digitally for us, if you agree to give us the e-Aadhaar, if you go through DigiLocker, pay us a payment electronically, and we are able to dedupe you electronically, our promise is to issue him a policy in 20 minutes. So I'm looking at my phone. We've just issued 5 policies today in a 20-minute from start to end. Issued meaning issued, delivered to the customer, not sent a letter or an SMS. Issued electronically, obviously. So to me, this is one of the important moves forward as to how do you make life insurance a OTC kind of a product. It encompasses this whole thing called simplicity. It encompasses this whole thing called, value delivery. And there are reasons to do it. There is minimal chance of free look cancellation. There is minimal chance of dissonance later. My, mis-selling probability goes down very dramatically. And I'm hoping it's the start for us. Today, we set out that 20-minute benchmark. Hopefully, that gets us more references. Hopefully, that makes people's networks grow faster. So that's, an added element of what we are working on, COVID or otherwise. How do you use this momentum? How do you use this market movement to be able to deliver more value to customer more relevantly, more simply in a shorter period of time?
Thank you. Mahesh, what's your take on the next steps and the big learnings?
I'll probably cover the aspect which Ashish and Kamlesh spoke a lot about customer. So let me speak about internal customers, what to do with the employees and what to do with the agents, because these are 2 big constituents for us. And I think as the great resignation is happening all over the globe, I think it's been a serious challenge in terms of recruiting employees, engaging with them, keeping them under the fold. And especially a player like Kotak, we believe a lot in our value systems and the DNA and culture of the group and the organization. So how do you really teach these COVID babies who have come during the COVID? Some of them have exited even during the COVID period, right? So that's something very disconcerting for all of us, because we really pride in our culture and pride in our ability to embrace people and bring them into a particular way of functioning. So I think that, to my mind, we need to work much more harder on it and try and be more innovative and creative in our engagement with our customers and with our employees. Second is the entire area about distribution in terms of how do we engage better, digitize. CX, UX is also all about the distributor himself, because we're still a lot face-to-face driven in terms of recruiting agents going out in the market, talking to consumers. While the process is still digital in terms of digital interfaces being used, finally the pitch is still being made by an agent. So how do we really build better engagement, build productivity, recruit agents completely on a digital mode? In fact, we are evaluating whether we can already recruit agents end-to-end on a WhatsApp mode, because WhatsApp is today offering a lot of business services. So how do you really get in WhatsApp to build engagement better within your employees and within your agents? So I think from our side, I think enough focus should also be there on employee and the agent in terms of how do we make them respond better to these kind of scenarios, and how do we continue to build productivity and scale in a continued environment of where we may not be able to hire and meet them physically. It has to be all done digitally, virtually rather.
Okay, that's great. Of course, the digital footprint will make a lot of difference to the company's lives and the policyholders' lives. And I hope that also cuts down on, I think one of you mentioned that it'll also cut down on the whole scourge of mis-selling, if I shall put it like that, especially in this tax saving season that we usually see.
Yeah. So how do we build a metaverse for our
Okay. So on that note, thank you so much for taking out time from your busy schedules and participating in this discussion. And good day to all of you, gentlemen.
Thank you.
Thank you.
Bye, Nidhi.
Thank you, Nidhi. Thank
Great
you,
seeing
Ashish.
you, Mahesh.
Pleasure.
Bye, Mahesh.
Thank you.
Bye,
Bye-bye.
Kamlesh.